welcome to another CSEC economics lesson. The topic for this lesson is financial instruments. Now, the financial instruments that we will cover include treasury bills, notes and bonds, corporate bonds, municipal bonds, equity securities, share and stock certificates, and certificates of deposits. We want to distinguish among treasury bills, notes, and bonds, and we'll start with treasury bills. So these are made based on, the distinctions are made based on the time period or the maturity period. So bills are typically sold at a discount from the par amount, which is the face value. So they're not usually sold at the price that is equal to the face value, and that's how you'd benefit as an investor. So you buy it for less than the face value, but at the end of the maturity period, you would be paid the par amount plus any interest that was a part of the agreement. So treasury bills have maturities of a year or less. Note the time period for the treasury bills. The treasury notes or T notes are usually not less than 1 year and not more than 10 years. So that's the maturity period. And they usually pay interest on a semi-annual basis. And when it matures, the investor would receive the face value. Treasury bonds are government securities that have maturities greater than 20 years. Or 20 years or more. So the T bonds earn periodic interest similar to the T notes, and at that point, the owner, at the point of maturity, the owner is also paid a par amount equal to the principal. So the owner would have gotten the par amount and interest over the years. Another financial instrument is a corporate bond. Now this is a debt obligation. It's like an IOU. So as an investor, you're lending money to the business and they're making a promise, a commitment to pay you back the interest and the principal in the future. So you will get the principal when the bond matures. There are also municipal bonds, also called munis for short, and that is a bond that is distributed by a local or state government. So the expectation is that you would receive interest similar to other bonds, and then when it matures, you'd also be repaid the principal in full. Typically, these bonds are used to raise money for local development. So for example, to build roads and schools and other projects that are aimed at improving things for public welfare. Equity security is also another financial instrument, and what it does is it represents ownership in a corporation. So this instrument gives its holder the right to a portion or a proportion of the earnings of the issuing organization. So you become a part owner, and so you have a right of the profits earned by the company. You have a right to a share of those profits. So the equity security is usually in the form of common stocks, and this gives the owner the right to a share of the residual value of the issuing entity in the event that the business is liquidating or closing down. And then there are also preferred stocks, which these investors are given priority over the holders of common stock. But it's a similar concept where both these shareholders, they have a share or an interest in the company. Now the share certificate, another financial instrument, is a written document signed on behalf of a corporation, and it's legal proof that you are part owner of a company, and it also states the number of shares. There is also a certificate of deposit, and this financial instrument is offered by financial institutions such as banks and credit unions, and it allows customers to earn a certain level of interest on their deposits, and this is typically a higher interest than regular deposits, and in return they must leave the deposit untouched for a certain period of time. And if it is they choose to withdraw the deposit before that period of time, then they face the risk of, you know, paying a penalty to withdraw early, and so they will lose some of their deposits. These are some of the sources used to compile the content for this video.